Yeah.
He's wiser, of course. Susie said we had an hour, but I thought 3 hours school with y'all today.
Yeah.
We'll go quick. We took Susie, sent an email with about 15 questions and Q&As. And then we expanded beyond that a little bit, and then we've got a little bit more material that y'all can digest. It's not fully exhaustive. Y'all can reach out obviously with questions after we get done, and then you'll have our contact information as well. So let's go ahead and jump in. Aaron and I own a few companies, some more family companies. LLC is kind of our holding company. Under that is We First Tax Service, some more management group, and Entity Craft. We try to bifurcate our services out just to be able to better market. As you all know, a lot of people look at We First Tax Service and they just think of tax prep, open 6-7 months out of the year and then we close. We're full service, so we do payroll, bookkeeping, accounting. There's a little bit of a difference between bookkeeping, accounting, sales tax, business formation. So we spent the last couple of years of just trying to put services where they belong under one entity. Some more tax and accounting services, DBA, We First Tax Service is what we're going to be speaking off the platform today. The more management group, that's kind of our bookkeeping and accounting leg. And then Business Pioneer, DBA, Entity Craft is our business formation, dissolutions, restructuring, and things like that.
Registered agent.
So registered agent services. So Aaron and I set up a business in August of 21 with the more tax and accounting services. Just a little bit of history about the business. We First Tax Service has been around probably 20-25 years in multiple capacities. I was approached by a lady I went to school with who used to work here as an accountant. And she introduced me to the former owner, Steve Weaver. Steve and I worked some things out and he sold the business on 12/31/21. He dropped his DBA and we picked it up. So we had the assumed name. So DBA is doing business as, or assumed names, we use those interchangeably. It's always the cleaner way of selling a business. So we haven't really changed the structure of We First Tax Service, but what we did is we broke out the payroll and bookkeeping. Do we have some issues on the?
No. I just
Maybe step into the picture a little bit.
Okay. So some more tax and accounting services, income tax, payroll tax, sales tax, which y'all don't really have to worry about. We'll touch on sales tax a little bit. The state's changing some things with sales tax, even around the country. That is kind of consumption tax, where income tax rates people believe should be going down. But if that goes down, sales tax rates are going to go up. States like Tennessee, Texas, Florida, no income tax, but they make up for it on sales tax side. We set up more management group about a year after we purchased We First Tax Service. And we're trying to run all our payroll, bookkeeping. There's clients out there that were budgeted forecasting. So we can offer quite a bit through that business. And then Entity Craft, where we're setting up businesses, doing export collections. I know this is foreign language talk, but operating agreements. And we can kind of touch on a little bit of those. If you have a question too, interrupt me. Today's agenda, just section 1, commonly asked questions. This is all Susie's questions that she said. So we're going to go through those. Section 2 is just some additional topics we should know. Section 3, compensation. This is probably one of the most important areas, I think, for you guys. Aaron and I and other accountants in the office always have tons of hard talks with the clients about this because we'll get agents in there. And I'm going to speak from an agent perspective today, where they'll come in, they've been 1099, there's no business. Even if there is business, it doesn't necessarily mean it's a strategic tax setup. And they pay a lot of taxes or any sort of that refund, which y'all are probably familiar with. So we'll look at that and then just final comments section. So we'll just look, these next couple slides are just an overview and then we'll break down these questions. This is section 1, part 1, business setup and structure. Do I need to set up an LLC or can I just use my personal name and starting out? 2, what are the benefits of having an LLC as a real estate agent? 3, what's the difference between an LLC and an S corp? Or should I consider both? And how do I pay myself? 4, when is the right time to set up a business bank account and credit card? 5, how do I start keeping track of my income and expenses as a realtor? 6, what kinds of things can I write off as a business expense? 7, can I deduct gas and mileage when I drive clients around? 8, if I work from home, can I run off part of my renter utilities? 9, can I deduct things like signs, business cards, Facebook ads? 10, are meals or coffee with clients tax deductible? And then the last part of section 1, how should I track the commissions? 12 is, do I need to save a portion of every commission check for taxes? 13, what are estimated taxes? Do I need to pay them? 14, should I be paying myself a salary or just taking money as I need it? 15, how do I avoid surprises when tax time comes around? There's probably going to be more questions you all have, but we can address those before. But I think Susie did a really good job of putting everything out there. This is probably the biggest question y'all have. So question number 1, do I need to set up an LLC or can I just use my personal name starting out? I'm assuming when most of y'all get into real estate, you're probably a sole proprietor. So a sole proprietor is just, you're just making self-employment. You haven't set up an LLC, you're just 1099. You can have multiple revenue streams where you're considered a sole proprietor. IRS says if you make $600 or more, whoever's paying you should issue you a 1099. Just because you don't get a 1099 doesn't mean you can't claim that income. It's your job as a taxpayer to report all your income. Just as important, we need to claim all your expenses. So that's kind of where we come in. We want to make sure when a client comes in and it's very obvious they probably use their cell phone and it's not on their business expenses. We'll ask the question, I'm sure you use your cell phone. So it's things like that. So just as important as income is, so is expenses. But you can start off as a sole proprietor. And you can continue the rest of your journey as a sole proprietor, that's fine. You are not an LLC, you're not a corporation. We won't talk about the different legal structures unless you have questions about that. Most entities are LLCs. LLCs have different structuring. If you are an LLC just by yourself and you set up a business, you go pay $40 to Secretary of State, and you get an EIN number, you're considered a single member LLC. That taxation is the same as a sole proprietor that has an IRS. There is no benefit really to just being a single member LLC. We always take it a step further depending on what the client is doing to elect an S corporation. So you would be an LLC / S corporation. But if you go in and you just pay $40 and get an EIN, you're considered a single member LLC. And that's it. You follow your, we won't talk about tax return numbers, but you follow your business income inside your 1040 personal tax return every year. The LLC, it offers more personal liability protection. So a lot of people obviously, you know, just on the surface, when they set up an LLC, it is to separate their business from their personal. Someone can sue you, they come after your business liabilities, come after your personal assets. That LLC separates those things, very important. You know, you have a rental, but a lot of clients will put several rentals under an LLC. We see most clients putting a rental under one different LLC, because if I'm renting from somebody and I trip and I sue the landlord, I can come after all his LLCs if it's under one. So they like to separate those out. In the context of a real estate agent, you know, y'all have your errors and omissions insurance. There are things that protect you. We're not fully aware of all the nationwide litigation issues against real estate agents, but I'm assuming that there are probably quite a few where agents have found themselves into some legal issues. So an LLC would just give you that protection that you need. In addition to making yourself more credible, you know, just it helps with taxes, obviously. We'll talk about that in a little bit. A single member LLC does not help with taxes. We've got to go a step further and do the S corporation. Out of our 1,500 businesses, about 90% are LLC / S corporations. There is a benefit to doing so, and we'll talk about that in further slides. We see a lot of people in the rental industry. They don't have to necessarily do an S corp election. We won't talk about that, but for the most part, just know if you're chasing income, you have less than 100 shareholders. The S corporation is usually the way to go. Two, what are the benefits of having an LLC? We kind of talked about that as real estate agent, liability protection, easier access to business banking, credit, potential S corp election for tax savings, and added professionalism. You can't go get a business. Some banks may let you, but most do not let you set up a bank account without an EIN number. That EIN number, employer identification number, even if you don't have employees, is a requirement to set up an account. A lot of clients will just even be sole proprietors, and banks will make them just go get an EIN to be able to set up a bank account. So you can separate the activity. Your income should go in your business bank account and all your expenses. It makes tax return a lot easier at the end of the year. Once you start commingling expenses, and we don't want to be, if an audit ever were to come up, which we hope wouldn't, it's a lot easier to explain those expenses, those write-offs when they're in a business bank account and a business credit card account. Most clients will have, and a lot of you probably have LLCs or slash LLCs corporations. So you probably know some of the stuff already. But it's very important when we set up a business, we tell the client, go ahead and go set up a business bank account. If you want a credit card account, it's probably easier just to go whoever with the bank offers. It's all on one portal there. And then start separating out your income. If you were going to go in and set up a business midway through the year, you're going to have business activity in your personal account. You're going to have business activity in your business account for half the year. So when it's our job at tax time to pull those two together, we don't want to lose out on what you used at your personal account. But then by a year and a half later or so, you should be flowing everything through your business account appropriately. What's the difference between an LLC and an S corp? An LLC is a legal structure, just like a C corporation is. You have C corporations, you have S corporations, you have partnerships. The list goes on. The S corporation is a tax election. It's not a structure. It is something that came out about 30 years ago or so. An LLC or an LLC as an S corporation are pass-through entities where the tax flows from the business to the owner, and that's where they're taxed. So the LLCs do not pay tax. LLCs corporations don't pay tax. Those flow to the owners. If it's a single owner, the net income or loss flows right to the owner. If there's two owners, like me and Aaron in this case, and say we had 100,000 in net income, he gets 50, I get 50 on my tax return. And we won't talk about all that today on how things kind of flow up, but just know that those are not taxed at the corporate level, they're taxed at the individual level. The switch between an LLC and an S corporation comes with some benefit to the IRS at the same time. A lot of taxpayers don't follow this guidance. It's our job to tell them what the law says. So with an S corporation, and this is going to confuse everybody else, like I said, that paying yourself as just a single member LLC, not an S corporation, is not a write-off. It confuses everybody, but what you pay yourself is not an expense. It does not become it. It's considered an owner draw. It just comes out of cash. It does not hit your income statement or P&L. When you pay yourself on the S corporation through the right means via payroll W-2, it is an expense. So there's difference. That doesn't mean you're necessarily paying a lot more. You're going to have a ton more savings with the S corp. And we can talk about that later slides. We've got a comparison chart. But what I said at the earlier of the presentation is the sole prop and the single member LLC. That just means one owner. There can only be one owner of a single member LLC. Hence the name. It is taxed the same in the eyes of the IRS. It is taxed as a disregarded entity. No tax benefit. You pay 15.3% self-employment tax on all net income. So if you all are making the 1099 from Remax or whatever, and there is no S corporation in place at income, say you had 100,000 in income and 25,000, or we'll just say 50,000 in expenses, that's 50,000 net income. You can multiply that times 15.3%. That'll be your tax bill before income taxes.
And then on your income tax level, you're double taxed.
Yeah, so you've got income taxes on top of the self-employment tax. So 15.3% is FICA tax. It's Social Security and Medicare. Everybody knows that. 6.2 Social Security, 1.45 Medicare. That's 7.65. You multiply that by 2 because they consider you the employee and the employer. That's 15.3%. So you're going to pay 15.3% net on your net income. When you do the S corporation, if we're paying you a reasonable salary, and we can talk an hour, and I won't do that today, but if you pay a reasonable salary, what the IRS says is really about a third of net income. We don't know what that is gonna be till the end of the year. You know, you've got 100,000 in net and revenue, 50,000 expenses. You've got 50,000 net income. We should be issued about $15,000 W-2. You can't go make that retro. You can't change that if you're doing payroll in the year. So sometimes owners will wait till the end of the year or just do it twice a year to spread out the payroll tax a little bit. But the IRS wants to see, once you do the S corp election, that is changing the LLC from an LLC / S corp to pay yourself a reasonable salary. If you do that, that means the difference between what you pay yourself and the net income is not subject to self-employment tax. So we'll have an illustration later, but there's lots of savings. We did a mock-up of just $100,000 in revenue, 25,000 in expenses, which are expenses are hard to come by in real estate alone too. You don't have cost of goods, you got mileage, you got some bills, things like that, but it's expenses are few and far between. So if you had 100,000 in revenue, 25,000 expenses, that means your net income is 75. If you're an S corp and you run a payroll on yourself compared to the single member LLC, you save about $4,000, and that's considered an administrative cost, which are paying someone to do your payroll, basically. So that number can grow astronomically. If you save about $4,000 on 75,000 net income, what if you make 200,000? And that's being a very generous W-2 at 40,000. We can even shrink that a little bit. But just for the sake of illustration, 40,000 is pretty good number to go by. Or when is the right time to set up a business bank account or credit card? We kind of talked about that right after forming your LLC. It ensures clean bookkeeping and audit protection. 5, how do I track my income expenses? Use softwares like QuickBooks or at a minimum Excel spreadsheet. I'm an Excel, I wouldn't call myself guru, but I love playing in Excel. So I set up my check register as a Excel template about 15 years ago, even before I went out on my own, and it was a game changer. No more of the writing it down, you know. Of course, I was having the budget and I needed to know every penny that was in there, but so same thing for business. Categorize it, you know, who you paid or who the income was from, and then very important just to go ahead and put, is that office supplies, is that meals, is that whatever it may be, rent. Because that's going to help accountants out at the end of the year, because a lot of clients will come in and they'll drop a shoebox off. We're rummaging through receipts. We've got to charge them a little bit more, and we still don't feel good about the numbers, but this is what we got.
Would you be able to provide to us like a list of categories that you recommend?
Write off deductions?
Yeah.
Yeah, and sorry, I should have said that. So in your packet, the right side is what we're talking about right now, section 1. It's not the PowerPoint, but it's by section 1, 2, and 3. The second page is a solo page. And then the 4th on the right side is the tax deduction checklist, primarily for
Lovely.
yeah. And then on the left side, I should have said this before. It's just an overview of our company and our offerings. And then we've got, if you're not a client, you want to become a client, new client information sheet. If you have an existing business, that's the 3rd page, and you wanted to come on board. And then the 4th is if you wanted to set up a business center. So we've got these in soft copy, we can email to you, but we wanted to go ahead and give it to you.
Thank you.
But if you're not using us, and honestly, I wouldn't pay for a subscription. I mean, at that point, it's $50, $60. You might as well pay an accountant to do it, you know, at that point. You do it in Excel, do it on, you know, some people do it on a napkin, whatever. Save receipts. We don't need receipts. It's our job to scan those in, keep them in your file. But we don't have to have all the receipts. I mean, really, if the IRS is they say, yes, we need to check every receipt. There's a lot of accountants who work on the honor system. Yes, you had this expense. We need to validate certain expenses as a material item. We need to see the receipt. But for $5 at you know, Meyer, you don't need to see that. But just what I do, what Aaron does, is we've got a folder. We'd actually like to get these ready for some clients. Maybe we'll be able to get this out by the end of the week. It's just like a little bank bag. and I just by year, just stick them in there every year. I write on top what it's for, office supplies or employee meals, and I'll put the date in, parentheses. That's just how I do it, stick it in there, and at the end of the year, I'll just put it in a manila folder. I got it if I need it. But that all flows through your account, so you should see all that. You shouldn't have to go through.
That's the benefit of the bank account itself.
Right, yeah. And, going through bank statements at the end of the year, it's no fun either. So it's like balancing your checkbook. You need, every business needs to know, as a real estate agent, you really need to treat yourself like a business because your tax is one.
Yep.
So you've got to keep up with it, or you're gonna overpay. Yeah, we hate seeing clients overpay, and we're in April or May, we can't do anything about it. Yeah. Section 1, part 2, tax deductions and write-offs. What kind of things can I write off as business expense, mileage? There's 2 methods when it comes to mileage, 2 methods when it comes to home office. Those are shared assets in a way where most clients don't have a dedicated vehicle. Most don't have a dedicated office space. So the IRS has to look at those through 2 lenses. In your industry, taking mileage is the best. You could take actual expenses, which means if you had a flat tire, you replace your tires and your transmission blows. And then we add up all those actual expenses, that's fuel expense, everything. And then we take a percentage of your business versus personal use. That's a little more involved, but sometimes it can provide a bigger deduction, but rarely it does with clients that drive a lot. So driving to the office is not a deduction. A lot of clients will taxpayers will get that confused. Driving to my office is not a deduction, but when I come here, it is. Going to see a client, so you kind of got to know. It's best to clock your miles at the beginning of the year, clock them at the end of the year. Say there's 20,000 there. You knew you drive the vehicle 60%, 70% of the time for business. We'll come up with a percentage, and then
If you're claiming a home office, can you count leaving your house?
cleaning the house.
No, it's leaving the house. Leaving, that would be great. Leaving the home, if you're
Oh,
leaving your home,
That's a question.
That's an
Yes,
expense,
yes,
right?
that is your office. So
that's
yes.
my office.
Yes,
So
yes.
So
So that's
if you leave your
that
home, you can count that.
that is a
mileage.
different, yes,
You go
that has
to
came up, yeah.
But the home office deduction is a form specifically.
That's different than the mileage. The home
Oh.
office deduction is a different deduction. But it's a good question for that one as far as mileage is concerned, because that is your office, so you're driving from the office to come here.
What method is that?
But the
That's when you
method
count that.
inside the 1040 Schedule C for the sole proprietor or the single member LLC, that is a dedicated form that is not a dedicated form inside the S corp. So, we would want to get as close to what that amount would have been for your home office deduction. I mean, I think it
And
maxes.
yeah, we're gonna talk about the home
Yeah.
office here in a second.
Yeah.
Sorry, everybody. Yeah, so the mileage, 2 rates, keep up with your miles beginning and the end. Home office, it's 2 methods. You got simplified method. IRS doesn't scrutinize as much. They give you $5 a square foot up to 1,500 square foot. We have to get that size of your office. So it's 12 by that. They give you 300 square foot max, which is a pretty small room, 15 by 15. That's the easier way. There's usually no questions. Okay, we give you a $1,500 deduction. Aaron's right. When it depends on your business structure, that'd probably be a little too much. We still try to give you the home. We still do give you the home office. We just have to do a little bit different than we do depending on the type of
in the
structure.
S corp.
But so the mileage from the home office
To this
physical
office would be a deduction, yes, because that is your office.
Yeah.
Licensing fees, business meals, but for me and Aaron walking back, that's not, because I can't consider that my primary office. The agent's primary office is not necessarily here. We kind of have to determine which is your primary office location.
Gotcha.
Mhm.
So if
Where
they're
you do
here
most of your
75% of the time,
But they're not paying rent here. They're not on the lease here. So
Right.
you can get that
Right.
mileage.
Yeah.
Mhm.
Can I deduct gas or mileage on our clients around gas, but choose one method? Most agents choose the mileage rate, which is 67, changes every year, 67 cents for 25. Apps like Mile IQ help. Once we elect on the second method, the actual expense method, just like the home office has the actual expense method, we have to keep it. So it's just a caveat. It doesn't really matter in your case, but we have to know if you took it, we have to keep it. We can't switch from actual expense to that. because the mileage rate that changes every year, 67 cents, it includes depreciation. It's pretty a gracious rate, really. It's not bad. You've got depreciation built into it, a lot of different factors that the IRS comes up to get that 67 cents per mile. If I more on the home office, 8. If I work from home, can I run off part of my regular utilities? That's the whole thing. We have to have good documentation. The simplified method, much like the mileage rate, is the easier way to do it. 300 square feet max, $5 per square foot. If we take the actual expense, there's a whole workbook formula for it. We've got to give it to the client. It's how much is your utilities, interest, we get depreciation. So there's a big calculation. There is a benefit to doing that sometimes. It's a little bit more work, but it may give you a couple more $1,000 write off. So that's, that's kind of something that we can keep in our back pocket should we need it, but it is more intuitive. You have to keep more documentation and things like that. 9, can I deduct things like signs, business cards, and Facebook ads? This is in the left, left side of the folder there. Typical deductions. Yes, these are considered advertising and fully deducted. 10, are meals or coffee with clients tax deductible? Yes, IRS gives us 50% if it's business related and discussed during the meal with the client's name on the receipt. So keep up with that. We're going to assume when you had a meal that it was legitimate. I can't go and feed myself Culver's by myself and write it off. I've got to have it in an intent to make income with another party discussing business.
If you're actually out, say you're showing property that's 2 hours away from here.
Yeah.
And you have to stop and get food.
Yes, and we really need we need a policy in place under that business. It's a lot easier to do it if you're set up under a business, because you can put some company records on file. This is your per diem policy. Like I used to work at Valvoline, and if we went out of town, we got 15 for breakfast. This was 12 years ago. 15 for breakfast, 25 for lunch, 50 for dinner. They allotted that certain amount. You can put something in place if you're away from home.
See,
Where you
I
have to
use
stay.
my IQ, it shows all that.
Yeah, but if you are away from home, yes, and that's where the law gets a little bit more gray. So feeding yourself is okay in that place, but it's good to have a policy in place.
Like a written
A
policy.
written policy in your company.
Business to you, the employee.
Yeah.
Basically.
Yeah.
The thing about the LLC is you are the business and the employee in that regards, right? So that's where the policy comes into play.
But yes, it's a good question because I thought about that. I knew that would come up. When you're away from home, it's considered more of an overnight, or you don't really have to be overnight, but you got to be away from home. And I'd have to kind of get them.
And that'll fall into probably the travel category meals versus the 50% deductible.
Yeah.
So
those might become more 100%.
So that's why good bookkeeping and note taking is saying this fell under my travel versus I'm out and about in the town I'm selling, right?
Yeah, because in the tax software, there's 2 places for meals. Like Aaron's saying, there's a place for travel meals, there's a little different place for more general meals.
Yep.
Section, last part of section 1, 11, how should I keep track of the commission checks I get, track gross commissions, splits, and the deposits into a business account? Use Excel or even better software or professional tracker. So it's good to know your income because people do make mistakes. I'm not saying that, but you kind of think about it. When we do a tax return, it's not, or when we're getting a client's documents, it's not uncommon for them to get issued a 1099 for 100,000 more than they were expecting. And so whoever issued the 1099 could have made a mistake. So we really need to know, taxpayers' jobs to know how much income they receive from the first of the year to the end of the year. You have those cases where you straddle the year a little bit, and it's like, they wrote it, but you didn't cash it, because we're considered, and we didn't talk about it, but there's cash accounting and accrual accounting. Cash accounting to recognize it when it hits it. So if I sold a property right now, and I was an accrual, I would recognize the income right when I did it. Versus a cash, I wouldn't recognize it till that hit my account. So same thing on the expense side, but hopefully it doesn't come up a whole lot. But a lot of people are like, oh, I just sold, so I'm going to get a $20,000 commission check. Can I push that into next year? Kind of depends on when you cashed it, when it was issued, but always good going back just to make sure all your income lines up with the 1099 that you get issued from Remax or whoever it may be.
Is there any way to hold back some of your expenses and put it on the following year? I mean, because you don't want to look like you're not making anything if you're trying to get a loan.
Yeah, that's kind of goes back to the cash counting, like recognize it when it hits, you've got some cases where you can do prepaid expenses, things like that. But I mean, you cannot pay an invoice as long as that they may ding you, but on the credit side of things, but yeah, you could not, you could do that. Just depends on how long you're able to pay with it. A line of income with expenses, the matching principle essentially.
It's when it hit it's when it hits the bank. It's when it,
But I mean, if I turn everything in, it looks like, wow, Janet, you're poor,
Right.
and if you're trying to try to refinance and or something, you're shoot yourself. in
Most
the foot.
bankers will know, hey, it's a volatile sometimes or seasonal. They should see, and that's why they ask for a few years typically.
and a lot of times they ask for a P&L, right? They're gonna ask for a profit and loss statement a lot of the time. So having it flow through to a software that produces that is paramount.
Yeah, it's.
Because it'll show periods versus the end of the year as a tax return would, right? So you're gonna see your peaks, your other items, and they'll know March is coming big for you and it's January or something, so.
As well, do I need to save a portion of every commission check? Yes, it'd be a good idea. It's gonna depend on your structure. Let's assume most of you all are not S corporations and you're just a sole proprietor or single member LLC. Good to save 25-30%, definitely. Just if you don't need it, that's great. Spouse income, children, other things can affect that, but try to look at your entity as a whole. So you're gonna know what that number is made up of. It's gonna go up or down depending on other factors in your tax return. But that number is probably good. 25% is what I would do. You can put it in another account, stash it away, however you want to do it. That being said, if you're an S corp and you're paying yourself on a W-2, most of our clients who are paying estimated tax payments and they come out and start doing W-2, we just say trash the whole thing. We don't need to do it because we can do it through W-2 channels. A little bit different.
For all of those, federal, state, and self.
Yeah, because it's we're paying estimated tax payments. So the IRS, and we'll talk about it in a second, but yes, W-2 federal withholding, which is your estimated tax payment, is withholding on your W-2 payroll check. So we can beat those up, take those down on the owners. That's the benefit of going with somebody like us. We're not like a payroll solutions or an AEP, but we do enough payrolls. We can modify things, customize it a little bit more to the client's needs for the end of the year tax. 13, what are estimated taxes? Do I need to pay them? And IRS says if you're going to owe 1,000 more in taxes, you need to pay importers. A lot of people just say, forget it. I'm just going to do it at the end of the year, and I'll take a little bit of a penalty and interest with it. I hate to say it, between me and you, I probably would do that too, because I don't trust the IRS. And I'll say this: if you can owe 50,000, yes, let's pay it. And IRS would slap my hand if I said that. But you also, if you're going to pay estimated tax payments, better give that information to your tax preparer, because if you made 4,000 estimated tax payments and you think you're going to owe 6, and you didn't tell them at the end of the year, you're still going to owe 6. It's not going to be 2, because you forgot to tell them they didn't put it in the tax return. So it creates some, you got to make sure you remember things like that. But they say if you owe 1,000 more in taxes, pay estimated tax payments. They want their money earned, right? They don't want their money late.
Is the fee significant?
It
No,
depends on how much that you owe. It depends on how much you owe.
I mean, it's not a
Ungodly.
dollar for dollar or anything. I mean, it's a low 3% or some number. like
There's a
that.
chart. Yeah, there's a chart. Yeah. Anybody that's here or on Zoom and they wanted to talk about the business, there's a lot more that we really need to talk about. There are things you got to do. If you're an S corp, you've got you got your own tax return now, not just your personal 1040. If you're a single member, it's still in your 1040. There's different due dates. So we're not going to cover all that because we didn't have time, but we would talk to you about it. And, we keep you in line, we keep you in compliance, we take it very serious, we try not to let the client miss deductions, there's no due date missing, nothing like that. 14, should I be paying myself a salary or just taking money as I need it? As I said earlier, sole proprietors, that's just, you make an income, no LLC, nothing there, you selling, cornhole boards,
Mhm.
that's you. You can sell cornhole boards, but become a single member LLC, there's probably no big benefit there, there's no tax benefit, there's liability protection like we talked about. More, you can get taken serious a little bit. These take on their draws, I know it's like a foreign language to you guys. S corps must pay a reasonable salary via payroll, the rest is not taxable. That's why the S corps is a big benefit, and it pays dividends. You really need to make about, you need to have about 50,000, I'd say actually more about $30,000 net income to us say you should become an S corp. If you've got 20,000 in sales, 10,000 expenses, Aaron and I, the team there, are going to say there's no benefits doing 2 tax returns, a little more administrative work, just stay where you're at. But the minute we think you're going to get above 25, 30 in net income, which is income minus expenses, net income, it's a benefit to switch to the S corp. There's timings on when you can do it. You have to do it within a reasonable amount of time, 3 years, 75 days. IRS has some wiggle room there, but if you're an agent and you're going to be in the game for another 2 or 3 years, you should do that. It's going to save you some money. If you're going to retire next year, probably not. 15, how do I avoid surprises when tax time comes around? Track everything monthly, save for taxes year round, with the pro quarterly, don't wait till it's too late. April,
Yeah.
late for the next year.
Yeah, March 15th is you're too late in most cases.
But we need to address the problems by November of that year, of the tax year. So we can make, a lot of clients that are doing bookkeeping and accounting like this, which you don't have to do. And we don't like to sell clients on any of that stuff. You can do that at home. We try to tell as many clients to do their own bookkeeping, but we have larger corporations, they have to do it. And come October, November, we can say, hey, you got this much in net income, you need to go buy some assets, you need to go do another salary, W-2, 401ks, there's things like that that can mitigate taxes. So you got to know your numbers, right? All right, that's it on section 1. I don't know if I should ask for questions or keep going. We got 10 minutes. Unless
I
you
think
know.
you guys, you're good on time.
Okay,
I think
okay.
most people, if they need to.
That's fine.
leave,
Yeah, I think we can wrap it up in 20. Section 2, other topics with understanding, when to switch from a sole prop to LLC to an S corp. We kind of talked about a little bit. Home office deduction to a right, kind of talked about a little bit. 3, audit red flags for realtors. 4, sales tax and services, Kentucky specific. 5, why you must separate personal business finances. I kind of touched on that already, so this one will go back. When to switch from a sole prop to an LLC to an S corp. Remember, those are 3 different structures in a way. Start as a sole prop, then an LLC once income is regular. This is kind of the black and white. And then elect the S corp when net income exceeds 50. We say 25, 30. In New York, they're probably saying this, and we're trying to save everybody as much as they can. So we'll say about 30,000 or so in net income. That's where you're going to at least get a couple of thousand in savings. It starts adding up, This path provides protection, credibility, and savings. So if you came in and you're a real estate agent, we're automatically going to say, we know your sales. Even if you're just starting out, it only takes a year or 2 to kind of get up and going. I don't think it's that hard to make 50, 60 in sales, 15,000 expenses. So the benefits there immediately, we automatically set you up with the S corp. And so if we did it, if you did it in any year and you're in August, we can go back to January and say that you had income, you didn't get it set up till later in the year. We could put it all in there for that year. Home office deduction number 2. We talked about it, taking 300 square. We always ask what's your square footage if you're a new client. If there's times that we need to look at the actual expenses, we will. Not that we don't push that, but we know you have to kind of know your client, like you all know. And if they don't have the documentation there, they don't have time to calculate all these actual expenses, it's more involved. So sometimes it's easier to take that $1,500 deduction. Number 3, audit red flags for realtors, mixing business and personal accounts. That's why having that LLC, LLC, corp, whatever it is set up. You can get a business bank account set up. We usually just say go with wherever you're doing personal banking with. Claiming 100% of your vehicle, that could be a red flag for anybody. You know, if you have one vehicle, in my case, it's not all business. It's not fair for me to write off 100% of everything. I should use like 75% or something. Excessive mills, travel deductions, or inaccurate bookkeeping. So we'll kind of sometimes we'll see a client will say, you know, we need to know, you know, if it's 50,000 and it doesn't come up a lot, but you know, we're here to kind of make sure we're not over reporting. Sales tax on services, Kentucky specific. Number 4, most real estate income is exempt, but side services like staging, photography will trigger sales tax. That came out a couple of years ago. The state is like been on like an every 2-year rollout of new industries that are sales tax required. I believe staging was one of the last ones that came out where it wasn't, because we had a couple clients that did interior decorating. Oh no, I gotta start doing sales tax reporting. So you gotta start collecting. Y'all don't have to worry about that. We don't have to worry about that goodness, but it's probably
It's on the radar
it's
before you know
coming
it.
up, I'd say.
So that would be if, say, an agent was charging a client extra.
Yeah.
For staging.
Photography, so if you know, the bill is
Okay,
separate. maybe.
Versus not
Mhm.
including it in a commission.
Yeah,
Correct.
right, yeah, so like if it was just, you know, interior decorating, or you're just doing photography, those are services now standalone that have to charge sales tax, so your bills got to, there are some industries where HVAC, you know, the service isn't taxable sales tax, the product is, so a portion of the bill is, it gets messy. But just something to kind of, we would keep you on the radar of it, of course. But it's probably a couple years away.
They're charging a percentage for us using credit cards too, on top of.
Credit cards are there, yeah, 3%, which is probably more like 4%. I think that's a big misconception. We found out ours is more like
Hard way.
4%. Merchant fees, yeah, so if you're taking credit cards or anything, yeah, you want to pass that cost on if you can. Everybody expects to pay it, you know.
That's probably why we've seen an increase in photography costs.
Oh my gosh,
Yes.
Yeah. Why you must separate personal business finances. We talked about having dedicated business bank account, credit card. This is critical for tax deductions, and liability protection. You don't want to commingle the expenses at all. It's just. Section 3, compensation, sole proprietor versus S corp, real world example. So scenario A, scenario B, sole proprietor or a single member LLC. And then I should have wrote LLC / S corp, because you a S corp after your S corp is just a tax election, it's not a structure, so don't get that confused. But if you made a net income of 75,000, so an example of 100,000 revenue, 25,000 expenses, that's your net income. Your self-employment taxes at 15.3% that we said is 11,475 on that number. You don't have any required payroll. Your tax prep's 500-ish or say, depends on where you're at. That's probably good average. Total self-employment tax is 11,475. Total admin costs 500. That's your 11,975.
Before that 75,000 hits your income tax.
Yeah,
bracket.
and then there are some income tax pieces on top of that.
Spouse W2,
Strenuous,
I mean,
but-
a million other
Yeah,
factors.
that doesn't mean that's just talking about for the business alone, a standalone entity, if you're just looking at it through one lens without other factors.
Yeah.
That doesn't include deductions.
This does.
This does include deductions, just just say you're just real estate agent, tax pro, whatever it is, that business standalone, before any other things you have done.
The net income of 75 is after deduction. So he's basically saying that he's basically 100,000 would be your gross, 25 of expense, net.
That's where you're gonna get taxed.
You're taxed on 75.
On 75, just in this example. On the S corp side, pay yourself a reasonable salary of 40, which is gracious. We could get even down a little bit lower, but this is good for illustration. Payroll taxes about 6120. Take remaining 35,000 as a distribution.
Which is not subject to self-employment tax.
Subject to this guy here. Bookkeeping and payroll admin, $1,200 a year, just for example, escort tax return prep, because you've got an additional tax return now with the escort. No longer just your personal tax returns, you'll have two. And then total payroll taxes, 120 plus both salary baked in, total admin costs, 2,200, total out of pocket, 820. So that's just on 100, that taxable 75. So you're saving about, next page. Sorry, I'm just gonna go back real quick to.
So
This is
that-
the total, that's the total for that guy. The savings would be on this side, sole prop, single member, tax, that number we saw, this is the yellow numbers. That's your S corp savings on 75,000 net income. If you had 150,000 net income at 7,500, and that's with a high W2. I know it's confusing, but I put it at 40. It probably could be more like 30, so it's probably more like 5,000.
Just that
It's a month,
switch.
just a switch like that, so that's 500 a month, so it's, people need to know, they don't know, a lot of clients don't know, but. Yeah, the law's out there.
So how does this affect if you have your own 401k and you put money in it every year, and I know a percentage of that up to like 20 or 20.
Well, the schedule, this A is gonna help drive self-employment tax greater. So you may have to run it through a W-2 if you're on the S corp side. Right?
Yeah, to get the employer benefit, you have to run it through the W2,
Yeah.
which the Georgia payroll can do, that's related, if you're maximized 401k, that's one of the.
Because this side doesn't generate self-employment tax necessarily. Right? Because when the K1 comes over of that $75,000, it's not generating that self-employment. Right? So essentially, where you're at is you want us to max out your contribution. It's going to be very limited because this isn't driving self-employment versus this one. Right? So there's a lot of other
It's
factors.
confusing, but yeah, so if you were, an S corp and we knew you had a payroll, we put it in the software. You could pay yourself, if you wanted to max out your traditional 401k 22.5, we'd at least give you a salary for that where you can maximize that. That's your taxes. So there's a bunch of factors there, but that is a play that you can do in addition to. You don't have to have a business to do the 401k. You run it through payroll as a requirement when you're an owner of the S corporation. Your spouse can still have one. If you've got a spouse, that's picked up on your personal tax return, but. Those would require a little bit more conversation, but. At the end of the year, when you're doing bookkeeping, a lot of clients will ask, hey, can I buy a car? You don't have to put, and I'm just gonna touch on a couple quick things real quick. You don't have to put a car under the business name. It's good to sometimes, but you don't have to. A lot of businesses don't have the credit to be established already to go buy a car. So if you're taking the mileage rate, we're essentially putting the business on your car. We take the actual expense, but it doesn't necessarily have to be titled in the business name. If you're claiming 100%, it needs to, well, we know we're not claiming it, we don't have a fleet of vehicles. If it was, those need to be titled in the business name.
I have a question. I've never once considered my business's credits. How do we find something like that?
Yeah, I think it's on I think if you register with like Credit Karma, if you've got an EIN number or any of the other
Yep.
reporting agencies, you should be able to see it. I actually have not done that myself, but banks will talk about it. So. we've got-
If you want to go get lending from your entity, for your entity.
Yeah,
So,
get a credit card in
Yes.
this same, because you don't know where real estate's gonna take you. I mean, people make really, really well on it. So we've got clients that are lower end and then higher end, so.
back to highlight on the car though, if you happen to say, let me put my car on here to depreciate over so many years, you can only take actual expenses. Mileage is out the window, right? But then the reason not to is because if you think you're going to get out of it in 2 to 3 years and you have to sell it and take capital gains potentially on it or roll it over and it's a nightmare.
It's our job to kind of say and assess the situation, like which method we're gonna choose for you.
Lease versus.
At least you can write off the expense. And this more comes down to personal. There's not much of a business or a tax.
That's my lease, I always lease.
You
I'm
always
just
lease.
wondering how much.
You
that's-
always heard when growing up, I did at least, don't ever lease a car. And then over the last couple of years, I started thinking, as much as we switch cars, you know, maybe it's not the worst thing in the world if you can get out of it every couple of years. I think if you're gonna keep the car for over 5-6 years, own it. If you're not, at least finance that back.
Right, and
It's just personal.
also I always have a car, if something happens, to it, and they
Yeah.
provide me another
Yeah.
vehicle.
That's nice.
Yeah, and the payment's lower usually, right?
Exactly.
Payment's lower. It's not. I mean, I've changed my position.
What if we're in, a car wreck doing real estate? So like, it's us in the rear, we just lost money, because I have to pay our deductible, even though we didn't do it.
Yeah, so insurance, you know, if it's, you know, we can write off insurance, no problem. Yeah, your deductible, I mean, it'd be a business expense. Yeah, now we have to use a percentage of it, because if it's business and personal, we're not gonna, you know, but that is another gray area. Do we stick that under actual expenses or on the insurance line on tax return? A different tax prep might tell you different. But to me and Aaron, it would be a percentage of that would be deductible.
It happened to
Not
me,
all of
and then I had to keep my car at the dealership for 2 weeks.
Yeah.
I paid insurance because I was afraid not to pay insurance.
Yeah.
You know, so I got additional insurance, double insurance. And
Yeah.
everything.
a percentage of it, but you'd have to be using the actual expense method, not the act of mileage rate. Yeah, so there's two methods, right? So we have to,
I like the mileage.
the mileage rate.
Mileage tends to be the best of both worlds.
What was I missed? Just follow-up questions, you know, reach out for anything that we talked about, of course, our office is off Lane Allen. Contact info, Mandy and Aaron, we're both partners in all the businesses you saw earlier. We operate primarily out of Weaver Tax, that's where we're at right now, but we do have the other businesses as well, so it'll be too much to give all the emails, but that's it. I can email this out as well as any of the soft copies in the folder too. We had a sign up sheet, but we didn't do that. Can we pass that around just in case?
Yeah,
Where's that at here?
And I
Which
missed an
one?
appointment now.
Yeah. Here, let's just, that way we know.
I'm so sick of doing it.
Yeah, I know.
Here, you can get that started.
We don't get service on Ohio.
Then last year, you guys transferred to my mission, so we got some pictures. So I was so it's a little complicated, obviously, but not be.
Yeah, I mean, our software separates out all those things. I mean, and the problem is it tends to drop it where the main residence is of the income. So a lot of times it likes to dump it all back into whether it's Michigan, whatever it is. But yeah, it's usually one you may owe, but you're gonna get a gracious refund in the other, and they tend to offset each other.
Oh, that's.
No, we don't want, yeah.
My tax.
Tax bill is-
Yeah, because I not already done this.
It's okay. No, no. it's okay.
feel
Very
like-
never, but-
You'll fix it, pick up on it. So I mean, but our tax. So it's out.
85% or so.
Yes, you got it.
That's why corporations- And we're not gonna email anybody. I just want to know about it.
So
No, honestly, I don't get it. And my cloud increase.
I was gonna say never about it. I was gonna say the PowerPoint.
So, great information, you know.